All right, so let's talk about Chapter 3, the operating process. And in particular, here we're going to talk about planning and control. So, those of you that were in class the other day, we've already talked through about half, probably really about 2/3 of this chapter. So, we'll go ahead and start walking through it again. So, the operating process, if you remember in Chapter 1, we kind of said, hey, this is the profit making activities of a business. So this is anything that has to do with revenues and expenses, right? Because when we talk about profit or net income, it's just the differences in our revenues and expenses. If you have greater revenues than you have expenses, then you've got net income, or what most people consider to be profit. Okay. One easy way to define revenues is it's simply the money that we get from customers. And expenses or costs, we'll call them costs on occasion. These are monies that we pay to vendors, or maybe we pay to a bank that we've loaned money from, or that we borrowed money from, or maybe we'll pay these to bondholders that we borrowed money from, right? So with the operating process, we're also going to break it down just a little bit further into 3 separate sub-processes, right? We're going to break it into sub-processes that have to do with marketing, sales, collections, customer service, right? And then purchasing, human resources, payment, and then conversion. Okay, so the first one, that's going to be our money making. All of those departments right there, they're revenue generating departments. The purchasing, the human resources, the payment, those are all going to be cost, right? They do not generate revenues for it. We incur expenses through those departments. And then finally, we have the conversion sub-process. And the conversion sub-process really only comes into play when we talk about manufacturing facilities, right? So this is taking raw materials, turning them into a work in process, turning that work in process into a finished good, and then finally taking those finished goods and making them available for sale and eventually turning those into revenue, right? That's the conversion process. We're taking something and completely converting it into something else, and hopefully at the end of that, we've turned it into revenue for our company. So the revenue process is just a series of interrelated activities that consist of interactions between the companies and its customers. That's the kind of boring part about this, right? So this is the sales that we make to customers. When we sell a product, a good, a service, whatever the case is, that's the part of the revenue process. And we do have several goals when it comes to the revenue process. The first is that we want to provide customers with a product or service that they want at a price they're willing to pay. So what this really means in the long run is we want to give customers what they want, what they expect, but we also want to charge them, really, from our perspective, as much as they're willing to pay. That's that free market, right? We're going to let the market correct itself. We're going to let the market handle itself. So whatever a customer is willing to pay, the highest point that they're willing to pay and still take that good, that's what we're going to charge them. Some of you may remember from your econ classes the kind of the concept of elasticity, right? Some products like eggs, it doesn't matter how much you charge for them, people are still going to buy them because they need them. But with something like beer or cigarettes, if they get too expensive, people aren't going to purchase them as much, right? Because they don't really need them. So that all falls kind of under those concepts there. Next, we want to receive timely payments from our customers. We really, when we sell things, and you'll see that a lot of the sales that we make, a lot of the purchases that we make even, in this class, we're going to create either a receivable if somebody purchases it from us, if we've made the sale, or we're going to create a payable if we are the ones purchasing. And those receivables aren't really cash, right? We consider them to be assets. We consider them to be highly liquid. If you think back, if you watch the prep videos, we talked about accounts receivable being a current asset, right? And it's one of the higher liquidity assets that we have, but it's not really cash. Okay, we want to actually receive cash from our customers, and typically speaking, we want to receive that cash within a time period that fits inside of our operating cycle. So remember, we talked about the operating cycle is kind of our cradle to grave, right? From the moment that the customer tells us they want something to the moment that we get paid for it, that is our operating cycle. So let's say we have a 60-day operating cycle. We would want to be paid within that 60 days. We also want to ensure that we have future sales, that we have return customers, right? We want to make a lifelong customer, somebody that's going to come back frequently and buy products from us over and over and over again. Okay, and we do that through good customer service, both at the beginning, the middle, and the end. So we kind of went through examples in class that we could think of. You know, these really aren't too hard to think of. The revenue process is pretty easy, pretty simple to conceptualize. And now we have primary activities of the revenue process. The first one, obviously, we want to generate sales, and we want those sales to turn into cash. Now, when we say cash in accounting, we don't just mean paper monies. We mean checks, money orders, credit cards. So those credit cards are going to be those ACH payments, right? Those EFT payments, electronic fund transfers, all that good stuff. So anytime I say cash, just know I'm talking about things that are highly liquid. The one thing to note about credit card sales is that typically they're going to come with a fee, right? So when you run the credit card at a store, they're having to pay a fee for you to run that credit card. That is why very often at smaller locally owned businesses, mom and pop shops, you'll see they have a sign up that says we're not going to run your credit card for less than $3.75, because they have figured that that is the bare minimum that they can run your credit card for and still make money. Okay. The next thing we talked about this just a minute ago, is those credit sales, right? These are the on-account sales. So when you see the term on account, just know we're talking about credit. So we have sold something on account to somebody. This is like if Missouri State went to like Staples to buy a bunch of paper, and Staples goes, hey, you're on our customer list. We're just going to give this to you. You pay us back. We trust you. You pay us the cash in the next 30 to 60 days. Okay, that's what credit sales are. If you look in that Getting Started folder on Blackboard, there's the crosswalk, or the commonly used terms, that will be on there. So when you see the term on account, you should recognize that as a credit sale. This is either going to create a receivable or a payable. It just depends. So the receivable is when we sell something on credit to a customer. The payable is when we buy something on credit from a vendor. Very often, you're given a discount, a sales discount, or like we talked about in class, sometimes it's called a trade discount, right? So if you're giving a sales discount, they'll give it to you as 210 net 30. All this really means is that you get a 2% discount if you pay in 10 days. If you don't, they expect the full amount in 30 days, the net amount. So if there were any allowances or anything like that, any other allowances that you had, that would be part of that net number. Okay. For control purposes, we have to gather all of this information, store all of this information in different places. We do this with different documentation like bills of lading, invoices, purchase orders, purchase requisitions, all kinds of different documentation so that we can follow this all the way through the process. So the next part, the next activity we have is that we want to receive and accept the order. So this is, what does the customer want and is it available? Okay. Once we've decided if it's available, we decide where do we get it from? Do we order it? Do we build it? Whatever the case is. And this is where we actually apply the discount, okay, when we receive and accept the orders. The next part of the process or activity is delivering goods and services. This is after we've built the order. This is after we've decided we can provide the service, okay? So this is when the customer actually has whatever the good is or has seen us perform the service, right? One thing to note, and this is a big part of recognizing revenue. When can we recognize revenue? When can somebody that sold us something recognize revenue? And a lot of that comes down to control. Who controls or who owns that good or service? So when we ship goods, we have to determine who the responsibility of the good belongs to at the time. So we have two different ways of doing that. We have free on board, right? So we call that shipping FOB is the first one. So FOB just means free on board. And if we say shipping FOB, we simply mean that the good belongs to the customer as soon as the carrier has possession of it. So if we're shipping it via FedEx, as soon as we put that good on the FedEx truck, the customer has possession of that item and it is as good as theirs. Okay, that is FOB shipping. The second one is FOB destination, And that just means that the customer doesn't actually have responsibility of that good until it actually arrives at the destination. Okay, so I think the example that we talked about in class was if it's a very expensive car or a very unique item, something we paid a lot of money for, that is unique and customized for you. Typically, you're going to see these be FOB destination. The shipper, the producer of the product, is going to ensure that for you. So we'll try to keep these videos to 10 minutes apiece. So you may see 4 or 5 of these videos, but I think if we keep them in bite-sized chunks, you can break them up and watch them throughout the week.